Welcome back, everyone. Today's video is coming at you from, well, the middle of May, and we are sitting here in a period of high uncertainty in the markets, and nobody really knows what's going next, what's going to happen. That said, I think there are some stocks out there that are maybe worth the risk of buying now with a bit of uncertainty in the future, and they may be priced in a way that is worth buying. And so for me, the three stocks that I'm going to discuss today are stocks that I do own, I have been buying, and I may be looking to buy a bit more as uncertainty clears up and or as we get closer to the other side or lower prices or whatever. So the theme for the stocks in today's video is going to be the question, what type of stocks would you not want to buy if you thought the economy was going to get much worse? And with that question in mind, the answers to that type of thing are what I am looking for in this video. Now, that's not to say that things won't get worse or that things will necessarily get better in the near term. I just think that most of the bad news is probably in at this point, and we should soon, in whatever pace we're able to, start to recover. And for clarity, no, I am not expecting a V bottom, not even close. I'm just looking at how much worse might things get and where we are now. Now, that said, all of these companies are cyclical and are economy focused. So in times like these, really the hope is that they don't lose too much money. Some may make money this year, and that's really a bonus, but really with what I'm looking at in this video, I'm just like, please don't lose too much money in the near term. That's really the optimism in me for these stocks. That said, all of them, all three companies, they do have um, growth ahead, growth potential, and cash flow. Well, most times cash flow, they're basically they should be profitable companies in most years. And one thing I do want to point out with regards to myself and me buying these things, I was rather underexposed to this type of thing, and you'll see what type of thing in a few seconds, but I was rather underexposed to this, and I do have a number of hedge type things in my portfolio, and I've been talking about some of them for a while, which means that I have certain things that kind of benefit from or disproportionately benefit from longer disruption or disruption type things persisting in the economy. So with that hedge and with that in place, I'm underexposed to this type of thing that I could take on more exposure. If someone has their whole portfolio in this type of thing, then it probably may not be the best time to buy more. That said, I am not maxed out on any of these positions. I may continue to buy much more. If it goes lower, I could see myself buying more of all of these things, any of these things, or some other things. Really depends. Um, yeah, not max position. And yes, I know buying this type of thing is at this type of time, maybe a bit early and maybe a bit crazy, but yeah, that's just me. Last 2 points I wanted to make very quickly before getting into the three stocks. First point, many people seem to be under the impression that the economy was great last year. I would disagree with that. I think that you'll see, especially if you look at the charts and what was going on with different subsectors, I think you'll see that the peak growth rate of the economy was back in 2018, not 2019. So it's already been a year and a half for some of these things. I remember last year, 2019, people were talking about, oh, there's going to be a recession, recession, recession. And a lot of the cyclicals got got hit pretty badly. And you could see even if you forget about anything that happened this year, you look at even in the middle of last year, a lot of cyclicals were down big. Now, obviously, much more. But the thing is, cyclical industries, they fix themselves. So the first of the three stocks is West Fraser Timber. Now, timber wasn't too heavily on my radar before, well, this year, frankly. But then I kept noticing something. I kept noticing big insider buying in this timber, insider buying in that timber, insider buying. So I did a bit of a look across the industry, and this is one of those things where there was huge supply destruction in 2019. And it looked like in early 2020 it might have been turning back up, and then the world stopped. So obviously there's going to be it's going to have to re-find a new bottom. And the thing is, when I looked at West Fraser, if you compare the productive capacity to the price, it's similar to what it looked like in the '09 bottom. At least it was a month ago or 2 months ago now, I guess it was. And it hasn't moved that much off the bottom. But the point is, the share price is much higher than it was in '09, definitely. But the share count is down dramatically and the production is up significantly. So I was looking at the historical comparison, and it was pretty cheap compared to its own history. Also, I like seeing insider buying, and there was all across the timber industry, as I said. And West Fraser, the reason I kind of picked it above its peers, it's not normally I don't normally go for the big best one, if you will. I normally try and find some smaller ones. But the point is, they have shown historically the ability to eke out a profit in bad markets when many of the peers haven't. And that's a theme in all three of today's stocks in that they are low cost and ability to persevere when the market is telling other supply or telling some supply to come offline. So yeah, that's West Fraser. And the one thing I will say is this is the smallest of my three positions. They do have a bit of debt, and so the near term will be to finish their growth project and delever. That said, I'm not really that concerned about the debt because most of the maturities are in 2024, and if we haven't had some type of recovery by 2024, I think I have bigger problems. But yeah, that's my case for West Fraser. Stock number two, Stelco. Now, I did mention this in a video, could be 2 weeks ago, could be 2 years ago. I don't know. Felt like recently. Anyway, I did mention it. And the point is, well, Stelco is a Canadian steel company. And I mention this because I think that the FX component here, foreign exchange, is a significant benefit. Now, why is that? Well, if you look at the problem for global growth around the world, what is it? Strengthening US dollar. You need the US dollar to pay off US dollar denominated debt and whatever. But the point is, a spiraling upward US dollar would be a significant risk for the ongoing growth of the world. Why could be an underrated benefit for Stelco is because Canadian Steel Company, costs in Canadian dollars and has access to the US market through USMCA. Now, don't get me wrong, Stelco also has investments in the US and could have issues with, well, doesn't do great with a stronger US dollar. It's just the hedge component that a stronger Canadian dollar probably means global growth around the world, commodities booming, strengthening Canadian dollar, which is worse for Stelco. That said, in that type of environment, being long a steel company is probably a good move. Well, as of if you got long now, but I'm not saying buy it then. Point number two, Stelco is already lower cost. They're bottom quartile of North American producers and have a strong balance sheet. This for me, is big because it allows them to invest now at the bottom, further lowering their cost and basically positions them well for the next cycle. Now, I say this is significant because when you look at the forward strip and prices, you see the steel prices for the next 2 years or whatever are around $530 a ton. That's US dollars. If we convert that and look at historically what that would mean in Canadian dollars for Stelco margins, they can really make decent money over the next 2 years, even if steel stays at 530 a ton. And if it does, well, then that's well below what some of the existing entrants would need to get back in the market. So basically, they're able to make decent, they should be able to make, well, profitability at least. They have some margins with today's strip pricing. Whereas if we need to get to a point, maybe there's stimulus, maybe there's something else, maybe whatever, where the top, where the most expensive, the fourth quartile, if you will, production needs to come back, then they're making significant margin improvements and should do quite well. You can look at the numbers for yourself if you want to see what I mean. But the point is, when do you want to buy this type of thing? I personally always wanted to buy a steel producer in a recession. Are we in a recession? Well, I don't know what terminology you want to use, but I think that this is the spirit of the buy the steel producers in a recession. Now that being said, it's a highly volatile sector, and if things get worse or if things don't recover, we could see it down further. That said, I think that with the futures and steel price are baking in well, not great things, so there's definite room for improvement here. That said, this is down 75% in 2 years, and Fairfax, which is a big value fund, was buying 200% higher. I think at this point it's a decent speculation. So that's what I'm looking at here. Pick number one is Linamar. Now, one thing I forgot to say when talking about Stelco, but it applies to Stelco and Linamar, is that I think that there's a good possibility that in the next few years, as the economy opens back up, that there's a bit of a focus in growth of taking back the supply lines, deglobalization, if you will. And I think that manufacturing, domestic manufacturing, taking it back to in-country, whatever way you want to describe it, I think that there's a good chance that there's going to be a push for that. And I think that Linamar stands to benefit from that type of thing. What they do is they manufacture mechanical parts for, well, cars and lifts and agricultural equipment. So they have the experience there. But if you look at what's happened in the past few months, in the span of a month and a half, Linamar managed to transition from making auto parts to making components for many different types of medical equipment. And one thing that they said in their call recently is manufacturing is manufacturing. And I think that this kind of shows or kind of demonstrates their ability in particular to not only expand, but really grow and be potentially a big part of bringing manufacturing back to, to North America, really. And so that's the bonus theme, if you will. But this company is one I've kind of had my eye on for a while. It's just kind of been like, I really like it. I really think it's cheap, but I'm concerned that things might get worse type deal in the general economy. And now I think it's just really cheap, and you get a whole bunch of potential upside, and really their balance sheet again is really strong. They're massive free cash flow generation. They're using it to grow the business. Most years right now it's kind of iffy, but I'm guessing you can figure out why that is. Um, so again, this year, very low hopes, very low expectations, if you will. But I think they're going to make it through, and it wouldn't shock me if they made it through stronger because again, balance sheet's very strong, so giving them a lot of opportunities to uh, add business from competitors whose balance sheet might be less strong. And again, this is a company like the past two, actually, both have big insider ownership, but this one, insiders own a third. So if you're looking for incentive and what the ownership and what the management is going to do, make it right, well, if you want to know if they're going to do what's right for the shareholders, just know they own a third. And so those are the three companies for today. And before I leave you off, I just want to reiterate a warning. These are high beta stocks, meaning if the market falls a lot from here or falls further, it's very likely that these stocks will go down further. And while I do like the risk reward setting, I think there's asymmetry in buying these companies. Yes, there's near term uncertainty, absolutely. But I really like the risk reward of these companies and I like lower cost versus peers and all that. But in the short term, often the stocks will care more or react more to the day-to-day moves of the market than the fundamentals for the company, which I think are all these companies. I obviously think they're going to pull through, and I think they're going to be strong on the other side. But in the short term, high beta is high beta. So caution, not that I'm suggesting anyone buy any of these. That's it for today. Thanks for watching, everyone. I hope you found one or two things interesting. If you found three things interesting, you might want to get some help. That said, remember, none of this is investment advice, and please do your own research before investing in anything. And with that, I wish everyone a great day.